Good morning, everyone. I'm Vince Lancy. In today's market rundown, we're going to discuss silver and gold, something significant on each commodity individually to go over today as developing over the weekend. Okay, let's start with the markets. There's the silver weekly. The dollar is 100.66, down 45. The 10-year yields are 364, down a basis point. S&P 500 is 562, up 60 basis points, up 0.6 of a handle. The VIX is 1711, stabilizing at higher 54. Gold is 25.80. That's spot, up 332, up about $8 overnight. Silver is 30.92, up 22 cents, near its highs of the night, I believe. Copper is catching up a little bit, 423, up 3.5 cents. It was up a penny when I looked last. Gold, silver creeping lower outside of that channel. WTI is down 10 cents at 69.43. Natural gas is 226, up 2 cents. Bitcoin touching 60,000 over the weekend and back to close to 57,000, the 58 gang. All right, Ethereum 2,300. Palladium up 7 at 1076, and platinum 993, down 5. Grains are, drum roll please, grains are all down. Soy, corn, and wheat down 1, down 2, down 8, 1022, 398, 589 respectively. And there you have it. Wheat the weakest in percentage terms, as well as pennies. And there's the weekly silver chart. I was doing a little work on that, and that'll factor into this conversation today. Here we are, silver and gold today. Premium analysis, short swap dealer stress. News, Goldman's commodity desk thinks silver is about to soar. The first part, premium analysis, we're going to share some of that with you. That's going to be based on the Commitment of Traders report that shows continued chronic and in moments acute stress by swap dealers on their short positions and why we think there's a problem there. The news is actually a report that Goldman put out recommending to clients to buy call spreads, and they give their reasons. Now, we were made aware of this from a Zero Hedge Premium report, and we're going to quote from that report. And then in the premium section at the bottom, we'll go through it in a little bit more, but we'll give you what you need to know to figure out what the heck is going on here. All right. Front page. There's the full-length example. There's the full-length analysis of the swap dealers that are under stress. I have no hard evidence. I'm not predicting that. This is not about banks going under. This is about swap dealers that are covering shorts at higher and higher levels and making less and less money and or losing money. John Paulson had an interview with CNBC. We have that there. It's an interview that's based on he differentiates between Harris and Trump along their tax implications and what it would mean for the market. And here's something we put out for founders last night about that silver report. We'll discuss a little bit more of that here. Let's get going. All right. This is excerpted from our Sunday Commitment of Trader discussion, which I just showed you. Sideways higher. This is an analysis of the Commitment of Traders report in conjunction with open interest and in conjunction with the market behavior itself. Sideways higher week with significant fund churning, with long and short funds adding small but short swap dealers covered aggressively from multiple cohorts, indicating producers and other swap dealers, suggesting market-making duties are secondary to market-taking needs. In English, shorts need to cover higher because longs keep adding and being patient, even at higher levels. Second chart. Swap dealers act like they are closing shop with no options changes, increasingly behaving as agency and not principal in both their future and, most obviously, their options daily activity, likely passing through risk back-to-back into producers, other clients, and possibly supranational entities. English, when you have a business and that business is under stress, as many of you have businesses, you will pass through because you can't be bothered with taking the risk. So I'll put you in touch with a guy that can handle it. I'll put you in touch with a guy that can handle that. And that's what agency is versus principal. Agency means they're intermediating the order. A customer wants to buy from them, they sell to them, and they immediately buy from someone else. Not for profits, just to honor the business, but they're not taking risk. They're taking less and less risk. Now, this chart here, which is probably the most interesting to look at from that perspective, this chart, the gold line, R. Blava, he's a founding member, and I talk about things, and he creates the charts that mirror them. He's a trader, and anyway, a valued founding member. All right, so here we go. The gold line is the gold price. The red and blue lines are open interest cycles. All right, so it's a little bit mixed up there if you're not familiar with it. But the thick green lines, they are green, right? No, I think they're blue. The thick lines, the thick arrows, we'll say, mark the bottoms and turning points for the gold market. And you could see those are higher highs, higher lows, I should say, right? And the reason that they're marked there is because they coincide with turnarounds in open interest. Now, it's easy. I want to just caution you. A bottoming in open interest is not necessarily a bottoming in the market. So when the open interest goes up, the market should go up. Yeah, that happens a lot, and it's happened that way for years. But just that's not what we're saying here. What we're saying here is that when the open interest bottoms, the market bottoms. Generally speaking, that's how it works. But we're noticing that the open interest is bottoming at higher levels, which indicates people that are long have deep pockets and they're not selling, they're not scared, they're in the money, and they might actually be bigger than the swap dealers that they're dealing with. All right, more on that at the bottom, okay? There's more charts, and it's going to be basically a very wonky, tighter version of the analysis that we did over the weekend. Now, this one I think is far more interesting. Well, not necessarily interesting, but far more top of mind, okay? Zero Hedge Premium notes that Goldman's derivatives sales trading desk writes in its latest weekly note there has been a huge influx of interest in precious metal and miners ETFs this week, and the bank's desks think SLV upside is one of the best trades on the board, and they give 4 reasons for that beyond the trade itself. And we'll discuss that also later on. And I do believe that Chris Marcus has something planned on that as well. If not, we'll ask him to. Okay, so there's the chart by Zero Hedge. This is like from their premium report. We're not showing the actual report itself, just this chart. So this is their version of the Goldman chart. And you see this spike here? That's a huge influx in SLV call volume, indicative of someone who thinks the market's going up. Now, there are good reasons for that. I didn't mean to do that. Well, there you're seeing, you're not supposed to show you that yet. Bear with me. All right, so why this matters and how to implement it according to them continues at the bottom. All right, simply put, the last time that we had this kind of a spike in options activity was in mid to late March. And you can look at the chart and see what happened then. All right, moving on. Sloppy segue. There we are. Moving on to the data on deck. Big week. FOMC interest rate decision is this week. That's on Wednesday. So the markets are starting to discount. Believe it or not, they're starting to discount a 50 basis point cut again. So the hope is creeping back into the market. So anything less than a 50 basis point cut will probably be bearish for stocks, which could be bearish for gold and commodities. Silver. One of the reasons that Goldman likes silver is because of the Fed cuts. And Bloomberg noted in a story, I'm not sure, about a month ago, that if the Fed cuts, gold will go up, but silver will go up more. That's it. All right, stay with us, and we're going to show you a little bit more of that. All right, let's take a look at silver in all the ways that we want to. All right, so this chart, if you're a technician, MACD has just turned up. So this is the beginning of a run up, possibly the middle, definitely not the end. So if we get above here, this shouldn't be a problem. Okay, that's the first thing. That's the first chart. Second chart. On the daily chart in silver, unless the market closes under 20, I'm sorry, 30 spot 19, 30.19, right? Or trades under 29.95 during the day, the market will not go sideways. It should go higher rather rapidly for the next 3 to 5 days. Next chart. Weekly. Well, what else can you say except this is a bull flag? And it's a choppy bull flag. It's hard to identify, but it looks like we've broken out of most of the measures of the bull flag, and you can draw a trend line here. I don't draw trend lines at Wix, but it's certainly not a bad idea. I think we've broken the bull flag, and the only thing that matters now is the top here. Like I think I don't think this line matters. Last chart. Let's go with a clean, regular daily intraday chart. Let me open my magic Bollinger Band system. And the magic Bollinger Band system says today, for the rest of the day, if we get above 3105, if we get above 3105 and close an hourly, it would close on an hourly basis above 3105, the market will have no problem taking out this high, and it will go 20 to 40 cents higher. I hate saying these things, but that's what this says. I'm not trading it. Similar to what happened here. All right, I'm Vince. Have a great day. All right, premium starts now. Where are we? Where are we? All right, folks. All right, so if you're premium already, as opposed to being a new premium person, you have the whole video to see. I'm not going to spell it out for you, right? But you could go there. But I'm going to give you the key things that matter, right? All right. This is the long and short. This is the fund buy and sell cycle. Okay. All right. Peak to trough, like flat, long out, flat, long out, flat. That one doesn't count. Flat, long out, flat, long out, flat, long out. You see what happens, right? So you got little mountains. Simply put, each mountain is accompanied by a mountain in the market. This is the highest open interest has been, not ever, but probably close to ever. We're nowhere near that. That's the first thing. We're nowhere near peak long open interest from the investment side. Nowhere near it. We are, however, near peak short open interest on the bank side. I'll give you an idea how stressed they are. So back to this chart. Open interest peaks, market peaks, market peaks, market peaks, market peaks. See the market's peaking higher as the open interest is peaking nowhere. Open interest peaks here, market peaks there. Open interest peaks here, that peaks here. Open interest peaks here, market makes a new high. Okay, that tells you this market is changing, it's evolving, it's growing. If you're a technician and I say to you stochastics don't matter anymore, that's what that means. All right, we're not going to analyze this publicly except to say that before, say, 22, there were rarely any volume days over 20,000 contracts. 10,000 was like your big alarm bell, whether to be bullish or bearish or something like that. Well, now we've got 20,000 happening randomly, rarely, and happening with increasing frequency over here. You can derive from that what you want, but again, that's another sign of a growing market. Okay, Goldman silver call. All right. According to Goldman, silver is a critical component of the AI build-out. No doubt, but even though it hasn't been quantified yet. Two, it benefits more than gold from Fed cuts. That's true. There's a Bloomberg picture on that. I will include that in here. I don't have it handy. I have to find it. And it's an uncrowded long as opposed to gold. Everyone's long gold because of the central banking. No one's long silver. There's actually CTA shorts in silver. Now, I haven't seen a CTA report in a while, but CTAs don't matter as much. But I put it this way. Seasonality wise, I like silver more than gold this year. And I like silver more than gold because everyone's looking at gold. And everyone who's buying gold, some of those people are selling silver because central banks aren't buying silver, they're buying gold. That's the mindset. CTAs will sell silver because of the economy. They'll sell silver because of China. They'll sell silver because it's not gold. And when the EFP flips a little bit, something that Bob Coleman and I used to talk about, when the EFP gets a little bit tight, look out. Un pobrecito, as my Spanish friends say. All right. This See this here? This is when the calls were bought last time. This is only the first day. It's not a cluster. So I look back and said, what happened last time? All right. This area here is when the calls were bought, not here. This is March 1st, if you can't see. That's when gold ripped and silver sympathized, but then stabilized. Well, the calls were bought in here. And then the market did this all the way up to here. Okay. And then the market pulled off, and then the market had this. So I would say that if the buyer is the same type of buyer, say a Chinese fund buyer, say a Chinese bunker hunt, then the market's going to, you want to expect a move to here. That's a bonus. Okay. So if Goldman is right, that's a good trade. Now, how do you express it? They suggest a call spread. I mocked up one here. They say buy call spreads 2 months out. Here's a call spread mocked up for you. Most of you understand these, but I want to do it anyway because I actually have an intern now that I'm teaching this stuff to, so it's perfect timing. All right, so here we go. They suggest buy a call spread 2 months out. You pick the strikes, you pick the prices, you pick the amount of money you want to spend. In this example, I'm saying I want to buy a long 30 call and a short 32 call, right? So the 30 call is my is where I start to make money on the call spread, and the 32 call is where my profits are capped. Okay, this is my loss if the market's below 30. The 30 call doesn't do anything. The market's above 30, I start to make money. The call spread starts to go in the money, but I don't make money until the money that I spent gets above this red line. This X is called break even. It's very important. You need to understand that the call spread goes in the money, but you're not in the money until the money you've spent is there. But that's what it looks like. The problem with the beautiful thing of these, especially in silver, is you are limiting. Look, silver is a very volatile market, and you are limiting your losses in a very high priced options market. And you're getting a good price because the 32 and the 33 call, those are big skew items. So silver has a huge call skew. So the 30 call in volatility terms, not price terms, will seem cheap relative to the 32 call. And it's justifiable. The reason that it's a problem, and it's not always a problem, but it's a good problem. If the market goes to $32, volatility will explode. Now, your 30 call will be in the money by $2 and you'll be happy. But when you go to take off the 30-32 call spread, it won't be as high as you want it to be because the 32 call will be so fat. If you're a sophisticated options trader, a call spread is just a beautiful thing to have on after a rally. If you're a simple, rather just directional call spread trader, just not looking for nuance, you just want to get in and out because you have a life to live, well, then you just sell it, you take your profits, and you're happy. But market goes to $32 and you have some time on your hands, or you're obsessive, you sell the 32-34 call spread, creating a butterfly. So basically you're long the butterfly for zero, or you, a little bit fancy here, you buy the 30-32 put spread, giving yourself a box, locked in, you're done, right? Or, you take the 32 call and you roll it to 34, you buy it and you sell a 34 call. That's the pig roll, I call that. Just be careful. Or if you're really goofy, and I'm not saying to do this, you would sell a 32 call, another 32 call, making it a back spread. Of course, above $34, you start to lose money. One of the trades that I used to like to do is put on a ratio butterfly when the market went here. I'm long the 30 call. I'm short the 32 call. The market goes up. I'm making money. Okay. And I want to put a butterfly on, but if the market drops, I don't want to lose the money that I made. So I would sell two 32, 34 call spreads. So I'm long 130 call. Okay. I'm short 332 calls and I'm long 234 calls. This is called a ratio butterfly. And what it does is it enables you to capture more premium, limiting your upside if the market goes up, but you never lose money if the market goes higher. It's you short two call spreads and you're a long one call spread. Yeah. So it's a ratio butterfly, or as we used to call it, a butterfly with a broken wing, 1x3x2. Very common in equities in the old days, and effective in skewed markets like this. Anyway, not advising you to do that, advising you to talk to someone who can help you with that. All right, I'm Vince. Have a great day.